Most people glance at their credit card number and assume it is nothing more than a random string of digits printed on plastic, meaningless and forgettable. The shocking truth is that every number tells a story about who you are, where your money flows, and how banks quietly judge your behavior. The mystery is not whether these numbers matter, but how much they already know about you before you ever swipe the card. Welcome to Meta Economy Lab, where you can learn and understand more about the economy and related topics so you can subscribe to the channel for continuous learning. To uncover these hidden secrets, we need to travel back to a time before digital payments, when money moved slowly and trust was built face to face. In the mid-20th century, banks struggled with fraud and inefficiency, pushing them to design a system that could identify accounts instantly across borders. The first credit cards were simple paper tools issued to select customers. But problems appeared quickly. Merchants needed fast verification, banks needed control, and fraudsters found loopholes almost immediately, forcing financial institutions to think in code rather than ink. This pressure led to the creation of standardized card numbers, a quiet revolution that most people never noticed. Behind the scenes, banks, payment networks, and governments cooperated to create rules that still control your financial life today. It identifies the network, silently telling machines whether your card belongs to Visa, MasterCard, American Express, or another system before any other check even begins. As global commerce expanded, these networks gained enormous power. They did not just move money, they set standards, fees, and rules that banks and merchants had to accept, embedding influence directly into card numbers. The next set of digits reveals the issuing bank, narrowing your identity even further. In seconds, systems know which institution stands behind your spending, what risk models apply, and how disputes will be handled. Banks use these digits to compare you with millions of others issued cards from the same institution, creating silent benchmarks that affect credit decisions long before you apply for anything new. The numbers that follow point to your specific account, acting like a fingerprint inside a massive financial database. This is where personal behavior meets institutional memory, recording patterns that last far longer than most people expect. It exists to catch errors, using math to confirm whether the number itself is valid, quietly preventing millions of mistakes and fraudulent attempts every day. What sounds like harmless math becomes powerful surveillance when combined with modern technology. Each time you pay, your card number helps link location, time, merchant type, and spending size into a detailed behavioral map. Banks claim this system protects consumers, and in many cases, it does. Fraud detection saves billions every year, stopping suspicious charges before damage spreads. But there is another side, rarely discussed. The same system that blocks criminals also profiles customers, sorting them into invisible categories that shape offers, limits, and interest rates. Consider two people earning similar incomes. The other spends heavily on travel and entertainment. Their card numbers quietly help algorithms decide who appears stable and who looks risky. Many cardholders discover their available credit changed overnight, triggered not by income but by patterns hidden inside transaction data. History reveals repeating cycles. During downturns, they tighten controls, and card numbers become tools of rapid restriction. After financial crises, entire groups saw limits cut simultaneously, not because of individual failure, but because algorithms linked their numbers to vulnerable categories. Another overlooked detail is geographic signaling. Where you spend regularly becomes part of your risk profile, shaping how banks respond to disputes or unusual activity. International transactions tell another story. The uncomfortable truth is that your card number travels more than you do. It passes through payment processors, merchants, banks, and networks, leaving traces even when transactions are secure. Tokenization and encryption improved safety, but they did not erase tracking. Real-world stories reveal the impact. Small business owners often see spending power rise after consistent payments. While individuals carrying balances feel invisible penalties grow, even reward programs depend on these digits. Points, cashback, and offers are targeted using transaction history, linked to card numbers, shaping consumer behavior subtly but effectively. Governments also rely on this system. Regulations, anti-money laundering rules. And sanctions enforcement depend on the structure of card numbers to monitor financial flows. This creates tension between convenience and control. The same digits that let you buy coffee instantly also feed systems capable of freezing accounts within seconds. As digital wallets and virtual cards grow, many believe numbers will disappear. In reality, they are multiplying behind the scenes, becoming even more abstract and powerful. The future promises biometric payments and invisible transactions, but the logic of card numbers will remain, embedded deeper into identity and finance. The first lesson is that credit card numbers are designed to identify, not just transact. The second lesson is that spending patterns matter more than most people realize. The third lesson is that awareness is the first step toward control. Looking ahead, understanding these hidden codes may be the difference between financial freedom and silent limitation. If this investigation opened your eyes, share your thoughts, like the video, and subscribe to keep exploring what banks rarely explain. Meta Economy Lab gives you new perspective to see and understand more about the economy and related topics, so you can subscribe to the channel for continuous learning.